Hi, this is Darshan Bhatt from Glovista Investments with our market outlook for the month of December. This past November, risk assets including global equities, credit, and commodities pulled back on the back of higher than expected inflation releases, a hawkish turn by the Federal Reserve as highlighted by Fed Chair Powell at its Humphrey Hawkins testimony, and global growth-related concerns tied to the new Omicron strain of the COVID virus. This risk-off sentiment also manifested in the strengthening of the US dollar by close to 2.4% during the month, a decline in crude prices by close to 20% during the month, and a sharp underperformance by cyclical equities, including small cap equities, emerging market equities, and a growth value factor underperformance in the small cap and mid cap domains. In our opinion, such market performance reflects investors' interpretation of recent developments as stagflationary in nature. On the policy front, the recent comments at the Humphrey Hawkins testimony by Fed Chair Powell, where he noted that the supply side constraints related inflation momentum is likely to be relevant for longer, and as a result, the Fed committee would entertain a faster tapering of its asset purchase program at its upcoming December meeting. Such comments resulted in a shift in markets' consensus as it relates to the ending of the tapering program from June 2022 to March 2022, and a discounting of 2.5 rate hikes of 25 basis points from June 22 to December 2022. From a macroeconomic perspective, we view the market's current stagflation concerns as exaggerated. More specifically, on the inflation front, we expect the inflation momentum to continue to decelerate over the course of 2022 as a host of factors come to play, including number one, deceleration in year-over-year growth rate of commodity prices, primarily owing to the base effects. Number two, increase in labor force participation on account of continued economic reopening and withdrawal of the fiscal stimulus to the household sector. Number three, disinflationary effects from the strengthening of the US dollar, which we have seen recently. Number four, withdrawal of the broader fiscal stimulus in the US. And five, continued relevance of the disinflationary secular forces emanating from aging of the population, globalization, and also labor-saving technologies. On the global economic growth front, we expect continued resilience in 2022 on account of proven economic strength in activity momentum in the face of the virus. Number two, continued increase in the percentage of those that are vaccinated. And number three, globally resilience in consumption dynamics. Finally, the latest available information on the Omicron virus points that the likely symptoms are expected to be mild. From a market perspective, the recent weakening in the growth and cyclical equities, alongside a rise in equity risk premia, could lead to a further declines in equities, as it will take time for markets' stagflation fears to be dispelled. However, over the medium term, we continue to like equities as an asset class on account of its attractive relative valuations and our constructive growth outlook for the year 2022. Within equities, we continue to like value-oriented sectors, indices, and countries on account of their exceedingly attractive valuations relative to their growth peers and their proven resilience in a rising real interest rate environment. Thank you for listening and good luck.